You know, when you think about a fortress, right? Like a real historical stone-walled fortress, the defining characteristic isn't actually the thickness of the walls.
Right, yeah. It's about the supplies inside.
Exactly. It's how the fortress operates when it's literally under siege. Like a poorly managed fortress, it just starves the second the supply lines are cut.
Oh, absolutely. It just collapses.
But a brilliantly managed one, I mean, they've got internal wells, they've got storehouses. Heck, they might even figure out a way to sell surplus grain to the invading army.
Well, maybe not that last part, but yeah.
Okay, maybe not that. But the point stands, you know. True resilience isn't just about weathering a storm. It's about turning a massive external disruption into a showcase of your own internal efficiency.
That is exactly the right imagery to start with today. Because when you look at corporate resilience, I mean, it's very easy to look good when the macroeconomic sun is shining.
Oh, for sure. When everything's just humming along.
Exactly. When global supply chains have no friction and geopolitics are, relatively stable. But when the world actually fractures.
Yeah.
That is when you get to look under the hood. That's when you see what an operation is actually made of.
Which brings us to the topic of this deep dive. Exxon just lost 10% of their Middle Eastern upstream oil production.
Right, to severe geopolitical disruptions.
10%. I mean, you lose 10% of your raw production in one of the most resource-rich areas of the world. By all conventional logic, your quarterly results should take a massive hit.
They really should. It should be a disaster.
Right. Yet they somehow posted a staggering $14.5 billion in earnings.
It's wild.
It is. So today, we are opening up the Q2 2026 earnings transcript to find out exactly how they engineered that paradox. Okay, let's unpack this. We are taking the data, the Wall Street analyst questions, and the corporate guidance and translating it into plain, actionable language for you.
And to understand how they manage this massive feat, we really have to start with the raw financials.
Let's do it.
Because the headline numbers tell a story of a company that isn't just surviving a volatile market. They are actively weaponizing their balance sheet.
Weaponizing the balance sheet. I like that.
Yeah. I mean, when you look at that $14.5 billion earnings figure, it's essential to understand that this isn't just a paper profit.
Right. There's a difference.
A huge difference. The metric that institutional investors look at even closer is the cash flow from operations. And that came in at a massive $23.6 billion.
Okay, let's actually pause on this financial terms for a second because the distinction is just so crucial for anyone trying to analyze a balance sheet.
Yeah, please break it down.
So earnings or net income, that's an accounting figure. It includes, non-cash items like depreciation, but cash flow from operations, that is the actual hard cash the business generated from its core activities during those 90 days.
Just raw cash coming in the door.
Exactly. $23.6 billion in cash.
Take it.
And from that, we get to the holy grail metric for retail investors, which is free cash flow. That sat at over $17 billion.
Which is just an unbelievable number. And what's fascinating here is how these numbers stack up against the broader Wall Street consensus, and even the internal expectations of the company itself.
Because free cash flow is essentially what's left over, right? After the company has paid all its operating expenses and maintained its capital assets.
Right. It is the discretionary cash pool. It's the fun money, basically. And CFO Neil Hansen admitted on the call that there were a lot of moving parts this quarter.
I bet.
Yeah, because when you have severe geopolitical disruptions, projecting things like refining margins becomes incredibly tricky for financial analysts.
So they were having trouble modeling it.
Exactly. You could actually sense in the Q&A portion that some analysts were struggling to reconcile the sheer scale of the global supply chain disruption with the absolute strength of Exxon's balance sheet.
And what do they do with that $17 billion in free cash flow? Because they didn't just stockpile it in the fortress.
No, they put it to work.
They returned more than $9 billion to shareholders through a combination of dividends and share repurchases. At the same time, they reduced their net debt by over $7 billion.
Incredible capital allocation.
And wait, they still managed to fund their future growth? They dropped roughly $7 billion into cash capital expenditures. So, meaning building new rigs, funding new tech, expanding facilities.
Right. So they're effectively doing three things simultaneously. They're paying the owners, paying down the mortgage, and renovating the house all at once.
It's a great analogy.
But this brings up a vital point of analysis during the call. Analyst Sam Margolin from Wells Fargo started digging into the structural nature of these returns.
Okay, and this is where I have to push back a bit. Or, well, at least voice the skepticism of a typical retail investor listening right now.
Sure, hit me.
Because I hear $14.5 billion in earnings, right? And I see conflicts in the Middle East, and my immediate cynical thought is, are these numbers just a lucky break?
The windfall argument.
Yeah. Like, is Exxon just sitting back, watching global oil and gas prices spike because of international conflict, and they're just gushing cash purely by accident? Or is there a structural, internal mechanism driving this profitability?
It is literally the most important question you can ask when analyzing a commodity-based business.
Right.
Because commodity prices dictate the top-line revenue for any integrated oil major. That's absolute. But the efficiency with which they convert that top-line revenue into bottom-line free cash flow, that is a story of internal discipline.
Okay, so what's the answer?
The answer is definitively structural.
Yeah.
If you look at Exxon's cash operating expenses and you adjust them for the fluctuating costs of energy and production taxes,
right,
those expenses are completely flat year over year.
Wait, completely flat?
Completely flat.
In an economic environment where labor, materials, and services have seen massive inflationary pressure over the last few years.
Yeah. And it gets even more pronounced. Neil Hansen pointed out that you could extrapolate their annualized 2026 cash expenses. They are effectively equal to their 2019 levels.
Hold on, I need to make sure I'm visualizing this correctly.
Good.
You are telling me that after 7 years of compounded global inflation, after massively scaling up production globally, their actual operating costs haven't budged from 2019 levels.
Precisely. They have managed to absorb all the macro inflationary pressures through internal efficiency gains.
Oh, wow.
Yeah, so that means every extra dollar they make from a spike in oil prices or a tightening in refining margins, it just drops directly to the bottom line. It doesn't get absorbed by a bloated corporate cost structure.
Because there's no bloat.
Exactly. That is not a lucky break on the commodity cycle. That is the architecture of a cost-cutting machine.
Okay. So we have established the baseline. The top line numbers are massive, and they are protected by a deeply entrenched flat cost structure.
Right.
But to understand the true narrative of this quarter, we have to look at the three main operational drivers. We have the global disruptions, we have the massive inflection point in Guyana, and we have the technological leaps happening in the Permian Basin.
Yes, those are the big three.
Let's start with the disruptions, because this directly explains that paradox we mentioned earlier, losing 10% of your production, but making record profits.
Right. To understand this, we have to look at the anatomy of an integrated energy company. Exxon doesn't just drill for oil. That's the upstream side.
Okay, the drilling is upstream.
Right. They also refine it, they transport it, and they manufacture end products like chemicals and specialty lubricants. That's the downstream side.
Got it.
And CEO Darren Woods addressed the supply shock immediately. The ongoing conflict in the Middle East forced a temporary loss of approximately 10% of their upstream production.
And just for context, 10% of Exxon's production is an absolute ocean of oil.
It's massive.
But here is the mechanism that saved them. While the upstream side took that massive volume hit, their downstream refining and chemical margins exploded.
They really did.
Yeah, chemical margins were up roughly 180% compared to the first quarter. But why? We need to explain the mechanics of a refining margin, which is often called a crack spread. Oh, good point. Yes.
So a refinery buys raw crude oil and it cracks it into usable products like gasoline, diesel, and base chemicals.
Yeah.
Their profit margin is the difference between the cost of that raw crude and the selling price of the refined product.
Exactly. And Darren Woods broke down the macro supply map during an exchange with Neil Mehta from Goldman Sachs.
What did he say?
Well, currently, the closures in critical shipping straits mean roughly 3 million barrels per day of global capacity are just entirely trapped. They're just unavailable to the open marketplace.
3 million barrels every day.
Every single day.
Yeah.
Furthermore, China has halted their fuel exports to prioritize their domestic market. So that takes another massive chunk of refined product off the board entirely.
Wow. Okay.
Combine that with ongoing sanctions on Russian refining capacity, and the global supply of refined fuel is severely, severely constrained.
So the global market is absolutely desperate for diesel, for jet fuel, for chemical feedstock.
Desperate is the right word. And when the supply of those finished products vanishes, the price buyers are willing to pay just skyrockets. The crack spread widens dramatically.
Right.
And Exxon is the second largest refiner in the world and the largest outside of China. So while they lost raw crude volume in the Middle East, their refineries in the U.S. Gulf Coast were running at over 95% reliability.
Which is just staggering efficiency.
Yeah, churning out record volumes of finished products to a market that was willing to pay a massive premium.
Woods stated he has practically never seen available refining capacity relative to global demand as tight as it is today. And, operating a massive complex refinery at 95% reliability is an incredible engineering feat.
I can imagine.
Yeah, refineries operate at extreme temperatures and pressures. They're handling highly corrosive materials. They require constant predictive maintenance.
So it's not just flipping a switch.
Not at all. Keeping them running at that capacity without unscheduled downtime is a direct result of their unified operational standards.
But they didn't just benefit passively from high prices either. The transcript details how they actively navigated the physical logistics of a broken global supply chain.
Right.
They established a new global trading and supply chain organization that managed to avoid roughly $750 million in annual disruption costs.
Yeah, and how they did that is a testament to data integration.
How so?
Well, when a shipping strait is closed, you can't just pause operations, right?
Right.
You have vessels loaded with crude that suddenly have to take a longer route, which means they arrive late.
Right, which means a refinery might run out of feedstock.
Exactly. So Exxon utilized advanced modeling to optimize real-time fleet reallocations. They dynamically reformulated the chemical makeup of their end products based on whatever alternate crude supplies they could secure on the fly.
They just routed around the damage.
It's supply chain gymnastics on a global scale.
So their downstream refining footprint perfectly hedged their upstream production loss. But, defense only keeps you at parity. To understand why their cash flow is projected to double in the coming years, we have to look at where they are playing heavy offense. We need to talk about Guyana.
Oh, Guyana. It is arguably the most successful deepwater exploration and production story of the modern era.
No question.
In the quarter, gross production from their Guyanese assets hit approximately 900,000 barrels per day. They had their fifth floating production storage and offloading vessel, the Araya Witu, set sail in June.
And it's on track for startup by year end, right?
Yeah, and they're advancing the Longtail project toward a final investment decision and evaluating a ninth vessel.
A ninth vessel. For anyone who isn't a maritime engineer, we should probably explain what an FPSO actually is.
Oh yeah, it's a bit of an acronym soup.
It's not just a ship. It is essentially a floating, multi-billion-dollar industrial city. You anchor this massive vessel in deep water over the drill site. It pulls the raw fluid up from the ocean floor, separates the oil, gas, and water on board, stores the stabilized crude oil in its massive hull, and then offloads it to smaller tanker ships that transport it to refineries.
It's unbelievable engineering.
It really is. Deploying 5 of these with the 9th on the drawing board is capital execution on a mind-bending scale. But, the fiscal engineering isn't even the most important part of the Guyana discussion on this earnings call.
No, it's not. The most critical financial concept discussed regarding Guyana was a piece of heavy industry jargon. They called it the desaturation of the cost bank.
Right.
And Doug Legate from Wolf Research probed deeply into this during the Q&A. He was trying to clarify the relationship between production entitlement and free cash flow.
Okay, let's unpack this with a detailed analogy, because desaturating a cost bank sounds like accounting nonsense, but it's actually the key to Exxon's future valuation.
It really is.
So imagine you are a real estate developer, and you partner with a landowner to build a massive state-of-the-art skyscraper.
Okay,
You, the developer, put up all the capital, say $55 billion to build the thing. The landowner puts up the land. You sign a contract saying that for the first several years, 75% of all the rent collected from the tenants goes directly to you, the developer.
Okay, so that's solely to pay off that $55 billion construction cost.
Exactly. And the remaining 25% of the rent is split between you and the landowner as profit.
That is an excellent framework, because in the international oil and gas industry, this framework is called a production sharing agreement, or a PSA.
A PSA, right.
A sovereign nation like Guyana owns the natural resources. Exxon brings the billions of dollars of risk capital, the technology, and the expertise.
And under their specific PSA, Exxon was permitted to allocate up to 75% of the oil produced, what they call cost oil, toward recovering their initial capital investments and ongoing operating expenses.
Right. So for the last few years, as they've been pumping hundreds of thousands of barrels a day, 75% of that oil was effectively the mortgage payment.
The mortgage payment?
Yeah, it was Exxon getting paid back for the $55 billion they fronted to build those massive FPSO vessels and drill those deep water wells.
So that $55 billion was sitting in what accountants call the cost bank.
Exactly. But here is where the narrative shifts. Because Exxon executed these massive offshore projects significantly faster than the industry average and at lower cost than projected.
Plus, global oil prices have remained robust.
Right. So because of all that, they have effectively paid off that $55 billion mortgage nearly 2 full years earlier than Wall Street anticipated. They have desaturated or emptied the cost bank.
2 years early on a $55 billion tab.
It's incredible.
So going back to our skyscraper analogy, the construction loan is completely paid off. What happens to the rent money now?
Now, the terms of the production sharing agreement automatically adjust. Because there was no longer a massive historical cost balance to recover, that 75% allocation for cost oil just drops away.
It's gone.
Gone. All the oil being produced now transitions into profit oil. And under the agreement, that profit oil is split 50-50 between the Exxon Consortium and the government of Guyana.
And this is exactly where Doug Liggett's question originated on the call.
Yep.
Because a retail investor or even a seasoned analyst looks at a spreadsheet and says, wait a minute, Exxon used to be entitled to 75% of the barrels for cost recovery, plus their share of the profit barrels. Now their total entitlement drops closer to 50%.
Right, looks like a downgrade on paper.
Yeah, so if their volumetric share of the oil goes down, isn't that a bad thing for Exxon?
It is deeply counterintuitive until you separate the accounting volume from the actual cash. And well, yes, the physical number of barrels Exxon is entitled to claim on their balance sheet decreases. But previously, the revenue from those barrels was dedicated to paying down a historical debt. It was capital recovery.
Paying the bank.
Exactly. Now, the revenue from their 50% share of the profit barrels is pure, unencumbered margin. The actual tangible cash flowing into Exxon's dividend and buyback pool increases dramatically.
It's the difference between collecting rent to pay a bank versus collecting rent that goes straight into your own checking account.
Exactly.
As Darren Woods emphasized, it's about value, not volume. Hansen confirmed that this transition marks a massive inflection point. Looking ahead, Exxon projects that their free cash flow from Guyana in 2030 will be double what it was in 2025.
Double the free cash flow from a single, already massive asset base.
That's wild.
And what's truly compelling is that they're still actively expanding the boundaries of that asset. They currently have a significant portion of their acreage under force majeure, awaiting resolution of the border dispute with Venezuela.
Okay, let's quickly define force majeure for our listeners. It's a standard legal clause in these massive international contracts that essentially pauses the clock on the agreement due to unforeseeable, unavoidable events.
Usually acts of God, right?
Yeah, or in this case, international geopolitical disputes over borders. It means Exxon doesn't lose their contractual rights to explore that acreage while the politicians and international courts sort out the boundary lines.
Exactly. But even ignoring the paused acreage, Exxon is utilizing cutting-edge technology to find more oil in the blocks they are actively working.
Right.
They took the massive data sets from all the drilling and exploration they've done over the past decade, characterized the complex subsurface geology, and ran it through advanced AI and machine learning models.
And what did they find?
Through this process, they identified 4 entirely new discovery opportunities that previous conventional analysis had just missed entirely.
Here's where it gets really interesting. In today's market, AI is it's the most abused buzzword on earnings calls.
Oh, 100%. Everyone says AI.
Right. Usually it's a software company talking about a slightly better customer service chatbot or a logistics company optimizing delivery routes. But Exxon is using artificial intelligence to physically interpret the Earth's crust.
It's fascinating.
How does AI actually find oil?
It really comes down to processing scale and pattern recognition. When oil companies explore deep water, they shoot seismic waves into the ocean floor, and they record how those acoustic waves bounce back.
Like sonar.
Exactly. Different rock formations, fluids, and gases reflect sound differently. It's a property called acoustic impedance.
Okay.
Historically, human geophysicists would analyze these massive 3D seismic maps to find visual anomalies that look like oil reservoirs. But an AI model can perform complex seismic inversion algorithms at a scale humans just cannot.
So the AI is looking at the same maps?
Yeah, but much deeper. The AI can be trained to recognize the microscopic multivariable acoustic signatures of hydrocarbons hidden in complex geological strata the human eyes just simply skip over.
Wow. So they are literally generating massive, tangible ROI from artificial intelligence by finding billions of dollars of oil that was sitting right under their noses.
Exactly. They are turning computational power into physical barrels.
And that intersection of advanced computing and heavy industry transitions us perfectly to the third major operational driver.
The Permian Basin.
The Permian Basin in the United States.
The Permian continues to be a domestic powerhouse. Exxon set another production record there this quarter, hitting more than 1.8 million oil equivalent barrels per day.
1.8 million, that's huge.
It is. But the narrative in the Permian has fundamentally shifted. It is no longer just a story of acquiring land and drilling holes. It is a pure technology and materials science story. Devin McDermott from Morgan Stanley probed specifically into the advanced technology Exxon is deploying to maintain this growth.
To truly appreciate what Exxon is doing in the Permian, we really have to talk about the physics of the shale revolution.
Let's do it.
In conventional oil drilling, you drill a vertical hole down into a porous rock formation, and the oil naturally flows up. But in the Permian, the oil is trapped in tight shale rock. It doesn't flow.
Right. It's stuck in there.
So you drill down vertically, maybe 2 miles deep, and then you engineer the drill bit to gradually curve 90 degrees, and you continue drilling horizontally through the target layer of shale. We call this horizontal section the lateral.
And for a long time, the industry standard was a lateral length of perhaps 1 or 2 miles. The engineering challenge is immense.
I can't even imagine.
You are applying weight and rotational torque to a drill string from the surface, pushing a bit that is 2 miles underground and moving horizontally.
Right. Imagine trying to push a wet noodle through a curved pipe.
That's a perfect way to picture it.
The friction of the drill pipe rubbing against the rock, the hydraulic pressure of the drilling mud required to power the mud motors and clear the rock cuttings, the geosteering required to keep the bit inside a layer of rock that might only be 30 feet thick. Doing that for 2 miles was considered a modern engineering marvel.
Which is why the statistics Neil Hansen laid out are so staggering. He noted that if you look at all the producing wells in the Permian drilled since 2020 that have a lateral length of 3 miles or longer, Exxon operates 1,200 of them.
Wow.
And to put that competitive advantage in perspective, their closest competitor operates just 400. You would have to aggregate the next 6 largest competitors combined just to equal Exxon's inventory of extended reach laterals.
And they aren't stopping at 3 miles. In the first half of this year alone, they drilled 83 wells with 4-mile laterals.
4 miles? It's insane.
4 miles of horizontal drilling. The mechanical torque and the friction management required to safely execute a 4-mile lateral without snapping the drill string or collapsing the wellbore is bordering on science fiction.
It really is.
How are they physically achieving this?
It requires a synthesis of operational centralization and chemical engineering. They manage these complex drilling operations through a centralized remote operations center based in Houston.
Okay, it's just remote.
Yeah. They stream gigabytes of real-time sensor data from the drill bit measuring vibration, pressure, gamma ray readings straight back to Houston. And there, algorithms and expert technicians optimize the drilling parameters microsecond by microsecond.
Microsecond by microsecond.
Yeah. But drilling the hole is only half the battle. They also have to stimulate the rock to get the oil out.
You're talking about hydraulic fracturing, or fracking.
Right.
Pumping millions of gallons of water and sand into that 4-mile lateral under immense pressure to crack the shale rock, with the sand propping the microscopic cracks open so the oil can escape.
Precisely. And Exxon is deploying advanced chemical surfactants alongside machine learning to optimize how they frack these massive wells.
Okay, let's explain surfactants because that is a very specific chemical engineering term. What does a surfactant actually do down there?
A surfactant, at its most fundamental level, is a compound that lowers the surface tension between 2 liquids, or between a liquid and a solid.
Like what?
Think of how dish soap interacts with a greasy pan.
Okay, the grease doesn't want to mix with the water.
Exactly. The soap breaks that surface tension, allowing the water to lift the grease away. Down in the shale formation, the oil is tightly bound to the microscopic pores of the rock. Exxon pumps proprietary chemical surfactants into the well to change the wettability of the rock.
So it's basically highly engineered industrial soap.
That's exactly it. It breaks the surface tension so a significantly higher percentage of the trapped oil flows freely into the wellbore.
It's chemistry and physics operating miles underground. Darren Woods actually mentioned a public challenge he issued back in 2018 to double their recovery rates in the Permian.
Right, yeah, I remember that.
He stated that by stacking these 40-plus new technologies together, the 4-mile laterals, the AI geosteering, the advanced surfactants, they believe they're on track to actually exceed that goal.
And there is a critical macroeconomic dynamic unfolding in the Permian right now that Jean Ann Salisbury from Bank of America highlighted during the call.
What was that?
It involves the relationship between oil and natural gas.
Oh, yes, the associated gas problem. When you drill a well in the Permian aiming for oil, a significant amount of natural gas naturally comes to the surface alongside it. We call that associated gas.
Right. And you can't just vent it into the atmosphere. You have to capture it and pipe it away.
But historically, the Permian has suffered from a severe lack of pipeline infrastructure. There just hasn't been enough takeaway capacity to transport all that gas to market.
This infrastructure bottleneck created bizarre market dynamics. At times, the localized price of natural gas at the Waha hub in West Texas has actually gone negative.
Negative, meaning producers had to pay people to take the gas away.
Exactly. More importantly, to avoid producing stranded gas they couldn't move, companies were often forced to artificially constrain their highly profitable oil production.
They had to choke back the oil wells just to avoid producing too much gas. It's an incredible operational inefficiency forced by infrastructure limits.
It is.
But Salisbury noted, and Woods confirmed, that a massive wave of new natural gas pipelines is coming online in the Permian starting right now.
Woods explained exactly what this means for operators. As that takeaway capacity opens up and the market clears, producers will become unconstrained.
So they can open the taps.
Exactly. They can prioritize the economic value of every well, which means opening the chokes and maximizing higher margin oil production, knowing the associated gas now has a clear path to market. It is a massive structural unlock that will improve the capital efficiency of the entire basin.
Okay, so if we synthesize these three operational drivers, they have a highly integrated refining network that acted as a shock absorber for global disruptions.
Right.
They have hit a generational cash flow inflection point in Guyana by desaturating the cost bank.
Huge.
And they're leveraging unparalleled material science to dominate the Permian Basin. That explains the current quarter perfectly.
It really does.
But Wall Street is a forward-looking machine. We have to look at what management is signaling for the future.
Which brings us to the strategic restructuring and corporate guidance. If you want to understand how Exxon plans to sustain this operational fortress, you have to look at how they are reorganizing their internal army.
What did they do?
On July 1st, they officially executed a monumental internal shift, integrating their global upstream operations into a single, newly formed global operations organization.
And to understand why this matters, we have to look at the history of how major oil companies typically operate.
Oh yeah, it's traditionally very messy.
Extremely. Historically, these super majors are deeply entrenched, siloed bureaucracies. The upstream division explores and drills, the downstream division refines, the chemical division makes polymers, and historically they operated like distinct fiefdoms.
With entirely separate management structures.
Redundant back-office HR and IT departments, and completely different engineering and safety standards.
It was wildly inefficient. By consolidating into a single global operations organization, Exxon has brought roughly 31,000 employees across more than 150 sites in 48 countries into one unified operational structure.
31,000 employees.
Under one roof, basically. The strategic goal here is to establish industry-first, standardized models for safety, reliability, and maintenance across the entire portfolio.
Think about the compounding knowledge transfer there. Under the old system, if an engineering team at a facility in Singapore developed a new procedure that cut turnaround maintenance time by 20%.
That knowledge might stay isolated in Singapore for years.
Exactly. Under a unified global operations organization, that process optimization is instantly captured, standardized, and mandated across every facility from Texas to Rotterdam.
And the financial impact of this centralization is already materializing. Darren Woods pointed out that centralized organizations have driven nearly half of their year-to-date savings.
Wow.
Yeah, since 2019, they have systematically extracted $16.3 billion in cumulative structural cost savings.
$16.3 billion.
And the trajectory continues. They are aggressively marching toward a target of $20 billion in structural savings by 2030.
And they also recently finalized their corporate redomiciling, officially moving their global headquarters from New Jersey to Texas, which is aiming for a more streamlined, predictable regulatory and governance environment.
Right. But restructuring a 31,000-person organization requires a massive technological overhaul. You can't just draw a new org chart and expect it to work.
No, you need the systems to back it up.
Exactly. They are rolling out an enterprise-wide process and data platform transformation. It's essentially a massive new ERP enterprise resource planning system with larger rollouts slated for 2027.
It is much more than an IT upgrade, really. An ERP system is the digital nervous system of a corporation.
It really is.
Historically, Exxon's various divisions used fragmented, incompatible software systems. This transformation is about fundamentally redesigning end-to-end business processes, ensuring consistent data taxonomy across the globe. Why does this matter?
I'll tell you why. Because you cannot truly deploy artificial intelligence at an enterprise scale if your underlying data is messy and fragmented.
Garbage in, garbage out.
Exactly. This platform transformation is the foundational architecture required to accelerate AI adoption across all their global operations.
So internally, the fortress is becoming leaner, more connected, and highly digitized. But externally, where is management allocating capital? Let's transition to liquid natural gas, or LNG.
Good pivot.
Jason Gableman from TD Cowen asked a very pointed question regarding their heavy exposure to the Middle East. Specifically, their partnerships in Qatar, especially in light of the geopolitical risks currently dominating that region.
It's a standard risk assessment question from an analyst. When a region becomes volatile, the instinct is to ask how quickly a company can diversify away from it.
Right.
But Darren Woods provided a very strategic macro-historical response.
Yeah.
He fundamentally rejects the premise of extrapolating the current crisis into a permanent destabilization of the region.
Interesting. What's his rationale?
His economic worldview is that the global economy is intrinsically dependent on the Middle East's energy output. Without it, global industry simply stops. Therefore, the overwhelming economic necessity will eventually mandate geopolitical stabilization.
So Exxon is not retreating. In fact, Arun Jayaram from JP Morgan specifically asked about Exxon's intention to help Qatar repair 2 of their existing LNG trains.
And we should clarify what an LNG train is, as it's a confusing piece of industry terminology.
Yeah, it has nothing to do with railroads.
Nothing at all. An LNG train is a massive industrial facility that takes natural gas, purifies it, and subjects it to a complex refrigeration process. It cools the gas to negative 260 degrees Fahrenheit.
Negative 260.
Yeah. At that temperature, the gas condenses into a liquid, shrinking its volume by a factor of 600. This allows it to be loaded onto specialized cryogenic ships and transported globally. When it reaches its destination, it is regasified and fed into local power grids.
Woods confirmed that Exxon is in active discussions with Qatar Energy. They are bringing Exxon's massive technical and engineering expertise to the table to expedite the repairs on these liquefaction trains and find a mutually beneficial commercial solution. They are doubling down on being a reliable partner.
However, Woods also highlighted their strategic geographic diversification. While they remain deeply partnered with Qatar, their upcoming pipeline of final investment decisions, or FIDs, naturally distributes their LNG footprint globally.
Where else are they building?
They are advancing massive advantaged LNG projects in Mozambique and Papua New Guinea, alongside the Golden Pass LNG terminal currently under construction in Texas. They are intentionally building a globally distributed portfolio that sits on the far left of the cost of supply curve.
Meaning that because the underlying extraction and liquefaction costs of these specific projects are so low, even if global natural gas prices experience a severe downturn, Exxon's specific projects will remain highly profitable.
Right. They are structurally advantaged.
Now, as we analyze management's posture, we have to look at how they are navigating regulatory friction. Things got notably tense on the call regarding the regulatory environment in Europe. Biraj Borkhataria from RBC asked about the growing trend of European governments levying windfall taxes on the downstream refining industry.
Yes, and before we dissect this, we must be absolutely clear for you, the listener. We are strictly and neutrally reporting Darren Woods' stated position and Exxon's corporate strategy regarding these regulations.
Absolutely. We are just the messengers here.
We are not endorsing a political viewpoint on European tax policy. We are analyzing how management is responding to a policy that directly impacts their balance sheet.
Exactly. So the context is that because refining margins spiked due to the global supply constraints we analyzed earlier, European refiners generated record profits.
The huge profits, yeah.
In response to these spikes and to address domestic consumer inflation, several European governments implemented or debated windfall profit taxes, essentially a supplementary tax designed to capture a significant portion of those unexpected, above-average profits.
And Darren Woods did not mince words in his response. From his perspective, as an industrial operator, he characterized these windfall policies as misguided and short-sighted.
What was his economic argument?
He articulated a specific economic argument. He stated that Europe has spent years implementing regulatory policies aimed at deindustrializing their economy and actively discouraging investment in domestic refineries.
Okay.
His argument is that when a geopolitical crisis inevitably hits and supply vanishes, Europe is caught structurally short on refined products. Prices predictably spike. And then, in his view, the governments attempt to scapegoat the industry with windfall taxes, rather than acknowledging that their own regulatory frameworks contributed to the structural shortage.
So his core economic argument against the policy is about long-term incentive structures.
Exactly.
He argued that the refining industry is highly cyclical. You have periods of low margins and periods of high margins. Operating a refinery requires billions of dollars of continuous capital investment just to maintain safety and output.
Right, it's not cheap to keep them running.
If a government caps profits or heavily taxes the upside during a boom cycle, they destroy the economic incentive for companies to invest that capital. If the upside is eliminated, capital will simply flow out of Europe to more favorable jurisdictions.
He specifically pointed to historical precedent, noting that the last time a windfall tax was implemented, investment capital demonstrably fled the European market, which ultimately led to greater domestic shortages and higher prices for consumers in the long run.
And Exxon is backing up this rhetoric with legal action. Woods explicitly noted on the call that Exxon is actively suing the European Union, arguing legally that the windfall tax constitutes an unlawful taking from the industry.
It is a stark confrontation between corporate capital allocation strategy and government economic intervention. But from an investor's perspective, it clearly signals that Exxon's management is willing to aggressively defend its margins in both the marketplace and the courtroom.
Definitely. Now, speaking of defending margins, let's touch on a highly lucrative, often overlooked segment of their business, the specialty products division.
Oh, this is fascinating.
Manav Dutta asked an excellent question about this. We spend so much time talking about gasoline, diesel, and LNG, but lubricants and base stocks are massive profit centers.
They absolutely are, and they require a deeply integrated value chain to execute profitably. Exxon's Specialty Products division delivered record earnings for both the quarter and the first half of the year.
That's great.
They've made strategic, targeted investments in upgrading their major facilities in Singapore and Rotterdam. These upgrades allow them to produce advanced synthetic base stocks.
Let's define what a base stock is. When you buy a quart of high-performance motor oil for your car, or industrial lubricant for a massive factory turbine, that fluid is a mixture of chemical additives and a foundational base stock.
Right.
The quality of that base stock determines the performance of the final lubricant, how it handles extreme heat, its viscosity index, how long it lasts before breaking down.
Exactly. By upgrading these facilities, Exxon can utilize a much wider variety of raw crude oils as feedstocks to produce these high-margin synthetic base stocks.
Which gives them flexibility.
A massive competitive advantage.
Yeah.
It makes them significantly less dependent on specific grades of Middle Eastern crude, providing another layer of insulation against regional supply shocks.
They also discussed a proprietary new material they're scaling up called Proxima. They recently completed a 35 kiloton expansion for this product and have taken the final investment decision on the next large step for a Proxima blending plant.
What's the market like for that?
Woods noted that while it takes time to penetrate and qualify a brand new advanced material in the market, the early customer feedback is exceptional, and they view the total addressable market as massive.
If we connect all these strategic elements, the unified global operations, the advantaged LNG portfolio, the aggressive defensive margins, and the expansion into high-value specialty materials, it sets up a defining question asked by Betty Jiang from Barclays.
What did she ask?
She noted that resource-rich sovereign governments around the world are increasingly looking for international partners to accelerate the development of their natural resources. She asked how Exxon evaluates and competes for these massive global opportunities.
And this is where management laid out the ultimate pitch. Neil Hansen laid out the comparative statistics. Exxon is currently executing roughly twice the number of massive mega projects as their nearest international oil company competitor.
Twice the amount.
And they aren't just doing more, they're doing it better.
Yeah.
They are executing these projects at up to 20% lower cost, and their delivery schedules are 20% faster than the industry average.
Think about the value proposition from the perspective of a sovereign nation. If you are a government sitting on billions of barrels of undeveloped resources, and you want that resource extracted quickly, safely, and cost-effectively to fund your nation's infrastructure, Exxon's track record, specifically the unprecedented speed and efficiency demonstrated in Guyana, serves as an unbeatable resume.
It really does.
They are systematically cementing their position as the undisputed partner of choice for global energy development.
Okay. We have covered immense ground today. We've crunched the headline cash flows. We've traced the operational drivers, the refining network absorbing the geopolitical shocks, the historical cash flow inflection point driven by the Guyana cost bank desaturation, and the physics-defying 4-mile laterals in the Permian Basin.
It's a lot to take in.
We've examined the centralization into a global operations organization and their strategic maneuvers in LNG and European regulatory battles. So what does this all mean? It is time for the bottom line. What is the actionable takeaway for the retail investor listening to this?
My verdict, based strictly on the financial data, the operational metrics, and the strategic posture presented in this earnings transcript, is definitively bullish.
Bullish.
And my reasoning centers entirely on the concept of the operational fortress we established at the beginning of this deep dive.
I share that assessment entirely. It is an incredibly bullish signal, because if you hold XOM stock right now, or if you are evaluating it for your portfolio, you have to look past the legacy perception of a slow-moving, bureaucratic oil dinosaur.
It's just not true anymore.
The data reveals a highly integrated, digitally enabled, fiercely disciplined cost-cutting machine. Think about the severe stress tests they just endured. A major geopolitical crisis effectively wiped out 10% of their Middle East upstream production.
Which is huge.
For a pure-play exploration company without an integrated safety net, that is a catastrophic event that shatters quarterly earnings.
But because Exxon possesses a globally integrated refining system, and because that identical geopolitical crisis choked the global supply of finished products, their downstream refining margins exploded.
Right.
They utilized advanced data modeling to reroute their fleets and optimize their feedstocks, capturing those record margins on the back end to perfectly compensate for the missing barrels on the front end. That is the definition of a durable, structurally hedged business model.
And look at the ultimate downside protection, their cash flow structure. They comfortably returned $9 billion to shareholders in a single quarter while aggressively paying down debt. If you are an investor relying on that dividend yield, you should find immense security in the fact that their cash operating expenses are flat year over year and sitting at 2019 levels despite years of global inflation.
Yeah, the flat OPEX is the key.
They have systematically squeezed $16.3 billion in structural inefficiencies out of the organization, meaning their break-even price for oil is lower than it has been in a decade.
Furthermore, they've just crossed a monumental threshold in Guyana. The desaturation of the cost bank means they have fundamentally transitioned from a capital-heavy recovery phase into a pure profit generation phase.
Pure profit.
That free cash flow is mathematically projected to double by 2030. They are combining that massive international offshore growth with unprecedented technological dominance onshore in the Permian Basin, deploying AI-driven geosteering and advanced surfactants to execute 4-mile laterals that their competitors simply do not have the engineering capacity to match.
It is a formidable, diversified combination. You have the immediate cash flow protection of an optimized global refining network today, combined with the guaranteed low-cost structural growth of Guyana and the Permian tomorrow.
Exactly.
The fortress is secure, the internal operations are lean, the storehouses are full, and they are actively, aggressively expanding their territory.
But as with any rigorous analysis, we cannot simply accept the current victory without looking for the hidden vulnerabilities.
Oh, always looking for the cat.
Always. To ensure we're evaluating this company with a critical eye, this raises an important question, and it's a thread I want to leave our listeners to mull over as they track this stock in the coming quarters.
What's the hidden vulnerability?
Throughout this deep dive, we noted that Exxon is currently generating absolute record refining and specialty product margins, largely because global supply is deeply physically constrained. We discussed the 3 million barrels of daily capacity missing from the market due to the strait closures, China's export bans, and the Russian sanctions. The market is paying a massive premium for every drop of a refined product.
Because they have to.
Because they have to. But history teaches us that geopolitical situations eventually resolve, or at least normalize, to a new equilibrium. So as an investor, you have to ask yourself a critical question. What happens to Exxon's top-line cash flow when those 3 million missing barrels eventually flood back into the open market, the supply shock ends, and those record refining margins inevitably collapse back to their historical cyclical averages?
That is the ultimate stress test for the future.
Exactly. When the macro environment normalizes, have they truly cut enough structural internal cost? And will the pure profit free cash flow inflation from Guyana be large enough to ensure the fortress remains highly profitable when the geopolitical premium completely fades away?
That's the billion-dollar question.
It is a dynamic that will define their valuation over the next 5 years.
A brilliant and provocative thought to end on. If the storm passes and the sky's clear, does the fortress still command the exact same premium in the marketplace? Thank you so much for joining us on this extensive deep dive into ExxonMobil's Q2 2026 earnings.
It's been great.
Keep questioning the numbers, keep digging into the mechanics behind the data, and stay informed. We will catch you on the next Dig Dive.